And the way I was going to frame this was these aren't my reasons why I don't like universal life insurance. These are actually clients' reasons why they don't like, universal life insurance. These are actual cases that people have brought to us. These aren't just me telling you my opinion. So, Anthony, if you could, can you pull up the Pac Life example?
Mm-hmm.
While he's doing that, I'm going to give you guys a little bit of background. This client came to us several years ago. They brought a universal life policy to us. It was with Pacific Life. And the way the lady framed it was she's had this policy for several years and she's been paying premiums, and she noticed that the account balance was not going up. And she brought this to the attention of her advisor. And the advisor said, everything's fine. It all looks great. Don't worry about it.
That was comforting.
Exactly. Yeah. That did not sit well with her. So she started searching for someone to take a look at it. She reached out to us and I looked at it. And here's what we looked at is exactly what you were talking about a second ago, Anthony, is what you guys should see on the screen is you should see an annual statement of a Pacific Life universal life policy. And what we've got highlighted here is we've got highlighted in green the fact that the policy increased by $15,000, just over $15,000 that year based upon the fixed account and then also the indexed account interest. That sounds great, right?
Well, it also depends what we started with.
Yep.
Right. But
yeah, exactly. And the rate, so if you look at this statement in the top right-hand corner of the screen, it says your policy's average interest rate is 2.23%. So she looks at that and says, hey, this is a positive number, right? I had a positive increase. Mm-hmm. If I tell you had a 2.23%, most people think, great, I'm positive. We looked at what she earned, and that was just over the $15,000. But what Anthony had pointed out is that along with Universal Life, there are fees and there are charges in there. And you can see here in red, policy charges over that last year were just over $40,000.
Whoa. Wait, yeah. But she made 15, but policy charges here
are just over $40,000.
Wow.
So they're promoting the gross, right, amount of, hey, you had an increase on this. But when we look in and we debit out kind of the losses, man, this poor lady, she's actually negative $25,000 over that last 12 months. And so, guys, right, that is deceptive marketing. That is borderline criminal, in my opinion, to be able to go out there and tell somebody you earn 2.23%, but in reality, they lost over $40,000 in cash value.
Yikes.
So, again, that's not my opinion. This is an actual policy that was in force. And so, take it for what it's worth. Anthony, what else you got?
Another reason why I do not like IULs is because the lack of flexibility. And what I mean by that is you can never permanently turn off premiums. Now, maybe if you look at an illustration, they may show you where you're not paying premiums out of pocket, but those premiums are being paid, but they're being paid from the cash value. So we're eating up some of the equity to pay the premiums. But with the whole life policy, it can be what's considered paid up. Mm-hmm. Now, you may have heard of some policies where it might be a 10-year pay or paid up to 65. In essence, what that means is like it paid up to 65 means you pay premiums until you're 65 and then you don't pay anymore.
Yeah.
And it's not like the cash value is paying them. You can't pay them. The premiums are totally turned off. And typically the way that we design our policies is, we really don't have any idea what's the futures hold. I mean, hopefully things go positively, but there's always that risk that things don't. And so what we need is that flexibility in the policy. So when things don't go as planned, with whole life policy, you can turn premiums off at any time. Now, if we do it before year 7, there's some mech issues, but so there are some ways to kind of finagle around it. But to me, it provides comfort that if I have a policy and I have a severe financial dilemma and I can't pay the premiums, I can just call the insurance company and say, hey, you know what? I don't want to pay premiums anymore. Mm-hmm. They will readjust the death benefit because that death benefit was under the assumption of premiums being continued to be funded, but the cash value is still going to be there. and the cash value is going to continue to grow. For example, I have a client, and he is in the retirement phase, and he doesn't want to fund the policies anymore. So you know what we did? We turned him off. Okay, and now he has this cash value that is growing tax-free and asset protected, and he still has a death benefit. With an IUL, when life happens like that, your options are limited. So that's one of the many reasons why I don't like IULs.
Man, I'm going to jump on that bandwagon too. And the flexibility was also a point that I had written down. But what I'm going to add to what you said, Anthony, is if you guys have ever spoken to or heard somebody promote an IUL, flexibility is one of the things that they promote. They say, hey, you've got all this flexibility on premiums. But what I'm here to tell you guys is that flexibility on an IUL is a double-edged sword. And what I mean by that is you can change your premiums, but also the insurance company can change your required premiums as well. Again, I've had this exact thing happen when I was early in my career. This is a long time ago. It's actually my first kind of run-in with a universal life product. A lady was referred to me. I met with her, and she was distraught. She had over a couple $100,000 that she had accumulated in her universal life policy, and it had sat there for several years. She hadn't made any premium contributions to it, and she got a notice from the insurance company that her cash value was at zero, and that if she wanted to keep the coverage, that her premium, which was around $5,000 annually, she was going to need to pay $25,000 in premium.
Can I, how old was she?
She was late 60s. And this is 13, 14 years ago.
That is, I mean, that ties into my next one. I don't want to step on yours.
Well, yeah, I was adding on yours as far as the flexibility goes, right? And so, again, right, they promote that you, the client, can change the premiums. But think about it. That means that they can too. One of the benefits of whole life insurance is that premium is locked. They can't ever change it as far as that base premium goes. We've got flexibility with PUA funding, but the insurance company cannot come back and change that on us. And so flexibility, favorability absolutely goes to whole life insurance.
You want to see the entire episode? Click here. If you want to learn how investors use infinite banking to increase their returns and lower their taxes, click here. If you want to see if infinite banking is for you and you have some questions, hop on a discovery call with us and one of our coaches. The link for that will be in the description.